start off here with the big elephant in the room, which of course is inflation. It's what is on the minds of investors. It's also what's on the minds of consumers. A lot of concern here that monetary policy might not necessarily be enough to bring down some of these inflationary pressures. There's a big question about whether fiscal policy can play a role. There's also a big question here about the communication coming out of the White House.
Well, look, we have a situation of an economy with historic strengths and historic challenges, and you're seeing that play out in real time. We saw the IMF and World Bank meetings are going on. Yesterday, the IMF reported and underscored what we know, which is the United States growth coming out of this crisis has been stronger and more resilient than any other major economy in the world. And frankly, the U.S. economy right now is in a stronger position than any other advanced economy, even when you take into account inflation. At the same time, inflation is a serious problem, and we need to orient our policy measures to address it. As you say, the principal responsibility and tools there are on the monetary policy side. I won't comment on those. On the fiscal policy side, we know there's a whole set of things that we could do right now that would help.
What are those conversations like? Because we know that there is a clear independence between the Federal Reserve, not involved in politics. Yet you have to be having conversation behind closed doors about what a 50 after 50 and maybe another 50 basis point hike in an election year, in a midterm year, what it does mean for the economy.
Absolutely, and we are looking and analyzing and focused on all of these issues. Institutionally, we try to maintain the degree of independence so that the Fed policy decision makers can make decisions independently. We think that independence is important. It's been eroded in the past. We need to rebuild it. And obviously, the biggest thing we can do is nominate and hopefully confirm qualified people into those roles. But as we're factoring in and looking out in the economic outlook, the Fed has charted a course. It is on that course, and obviously that will affect things. But we also have to factor in what we can be doing in terms of our own executive actions and on the fiscal policy side as well.
Talk to us about how you see the energy sector's role in the broader economy, both as a provider of growth. The energy sector obviously has become a very large contributor to economic growth, but also a detractor from growth in that consumers and households are generally struggling with higher energy prices. How do you frame a policy that attacks both of those sides effectively at once?
Well, it's a great question because, and we have changed. We're in a very different position than we were 10 or 20 years ago in two respects. One, because the energy production sector is a much larger share of our economy, increases, for example, in headline oil prices have a different impact on overall GDP than they would have 10 or 20 years ago. And number two, our economy is more energy efficient. We are, in terms of the cars we drive and the homes that we live in, we are less energy intensive than we were as well. That does not make it any easier for typical people who are pulling up at the pump and facing those high prices, but it does change the calculation in terms of growth.
And you understand, though, the optics of this. When people go to the pump and they see the higher prices, or they go to the grocery store and their final bill that they get at the checkout is, 50% more than maybe what it was a few months ago, that they point their finger at President Biden, whether it's fair or not. You have to realize that here. Has there been discussions, though, about more ways, not necessarily just to bring down prices, but also just to change the optics and the narrative a little bit so that people understand the macro dynamics out there?
Well, I would say, number one, absolutely, in understanding the pain and also the uncertainty that it creates when people see and have to experience high gas prices, high food prices. And in terms of changing the perceptions, we think the thing that we can actually do is try to deliver and demonstrate that everywhere this president can, he is taking action. You saw that with respect to oil and energy prices, the historic release of the Strategic Petroleum Reserve. Is that going to solve the entire problem? No. Is it something that he concretely can do in a historic way that will actually help? Yes. And likewise, we look at other families' costs. I mean, a lot of the way to think about this is how a typical family makes their monthly budget add up. And food and energy contribute to that, but so does housing costs, and so does childcare costs, so do prescription drugs and healthcare costs.
Right.
So if we can move
something that most people say they can't afford, regular people, with regards to childcare, we know the housing market is crazy.
That's right.
Most people look at the housing market prior to the rise in rates and they say you couldn't afford to buy a home, and at a 5% interest rates for a lot of people, it puts it further out of reach.
That's right. So we could take steps right now now to cut the cost of child care in half, reduce dramatically the cost of prescription drugs, and also increase housing supply, build more affordable housing, and do that
without help from Congress?
No, what we need is Congress. The most constructive thing that Congress can do right now is focus on lowering costs and lowering the deficit. Both of those, lowering costs would give typical families some relief and some breathing room right now. Lowering the deficit would help to provide some accommodative to reduce price pressures in the economy. Both of those are well within reach. The policies are well spec'd out. We need to work with Congress to actually move that ball.
Pivoting just a little bit, just toward broader economics, traveling, the mask mandate, of course, that we saw by the federal court down in Florida, sort of overturning that. Now, it was set to expire anyways, I believe, on May 3rd. The president coming out saying it's all, of course, up to individuals to make whatever decisions they now want. In the face of that ruling, does that have any sort of big impact that you see on the reopening of the economy, people traveling, people getting back out on the airplanes, and reopening as we continue to sort of come out of this?
I don't think it's going to affect the trajectory. I think what we have seen over the course of the last several weeks is a quite solid uptick in travel and leisure-related activities. We're seeing that in hotel accommodations and TSA, and I think that's hopefully going to continue. That people are feeling more confident, and because we have gotten to the vaccination levels and the boosting levels that we have gotten to, then people can feel more confident to do that, and that'll be good for the overall economy, and also good to this shift that we have been all talking about and looking for from goods to services. That's a key part of it.
What conversations are you having, though, with regards to our international relationships, particularly with our biggest, or what was once one of our biggest trading partners, China? The idea that a lot of those tariffs are still in place, a lot of the people blame those tariffs for some of the inflationary pressures. Why hasn't there not been more discussion on either easing those or removing them?
Well, we're having conversations across the board, including with the Chinese, about them fulfilling the obligations that they made to, for example, fulfill purchases of U.S. goods as part of the trade agreement. But we're trying to step back and actually take a broader view, that the trade policy that included tariffs but also purchase commitments in the prior administration didn't work. It didn't work to change China's behavior, and it didn't actually work to bring real benefits to U.S. consumers. So what we've done is a holistic rethink. It's not about any individual tariff line, which in the individual is not going to have effect on macro policies. It's resetting our orientation on trade policy to focus really where we see those concerns with the Chinese, and that's with their state-centric approach to dominating particular sectors that put our economy and our national security at risk, for example, like semiconductors.